Hello, my name is Garrett Kraker, and today I will be speaking to you about discounting provisions for contingent liabilities and how they differ between GAAP and IFRS. If you look on the first slide, under GAAP, contingencies may be discounted if the aggregate amount of the liability and the timing for the liability are fixed and determinable. GAAP does not require that contingencies be discounted, but instead leaves it up to the company as a choice. If a company were to elect to discount their contingencies to the present value to reflect the time value of money, it would show a lower balance in the liability account on the balance sheet, as well as indicating that this company was expecting to incur this liability. Since the amount has to be fixed and the time also to be paid fixed or determinable, this means that the company knows what amount they have to pay and when they have to pay it, so it is very likely that they will incur this liability. If the company elects to discount the contingency to present value, they also have to make a few disclosure notes to their financial statements. If they discount the contingency to present value, they will have to disclose the discount rate used, the expected aggregate undiscounted amount, the expected payment for the preceding 5 years, as well as reconciliation of the aggregate amount to the amounts recognized. Under IFRS, the contingency is expected to be discounted to reflect the time value of money given that it is material. So under IFRS, you would book the present value. It's expected rather than up to choice. It's required. Instead of under GAAP, it is a choice whether the company wants to book the contingency at its present value or just book it all at once. So if we go to the first example, Crater Mining Company has a contingent liability for environmental restoration. They estimate the liability to be between $75,000 and $125,000 payable in 10 years with a borrowing rate of 10%. So under GAAP, first you would debit an expense for $75,000 and credit an expense or credit a liability for $75,000. The reason you choose $75,000 is because according to FASB, GAAP companies are allowed to choose the lower of the estimated range. So between $75,000 and $125,000, they're gonna book $75,000 as their liability. Under IFRS, it's a little bit different because you have to, according to IAS, you have to choose the midpoint of the estimated range. So between $75,000 and $125,000, an IFRS company would have a contingency of $100,000. However, they would take the present value of this $100,000 in order to reflect the time value of money. So $100,000 for 10 years at 10% is going to leave you with a debit to an expense of $38,554 and a credit to a liability of $38,554. So moving on to the next slide, if we look at year 2, there are no additional entries that GAAP has to put into their books. They already recorded the liability at $75,000, a credit balance, and expensed it for their debit. So on their balance sheet, you would see a credit balance of $75,000 from the previous year for that liability. Under IFRS, in year 2, they would have to make a present value adjustment, which would show how the amount that they recorded increased to get to that total amount of $100,000. So they would debit $3,855 to an expense and credit the liability $3,855. This would then raise the liability from $38,554 to $42,409 as the credit balance in the balance sheet for that liability. So the question is, which method is better? And it just depends on perspective, Because if you're a preparer of a financial statement, you would elect to use the IFRS method. That's the one you would prefer, because it would show a lower effect on your long-term liabilities. And the 42,409 credit balance for liability is a lot less than 75,000 credit balance for the liability. If you're an investor, however, you would prefer the GAAP approach, because that would be the more conservative approach and would make it a little more transparent into what the company is going through for this contingency. And if a company were to elect for the present value method under GAAP, then it would be an indication to the investor that this company is very confident that they will incur a future liability. And this would just lead them to more clear path of what this company is going through and what contingency they are dealing with. So over the course of this presentation, we were able to talk to you about contingency gains, restructuring costs, recognition, measurement, and discounting provisions. Thank you for your time, and if you have any questions, feel free to let us know.